Thank you, Mr. Chairman. Mr. Donalo, I want to start with you. 25 years ago, I was a research assistant to Professor Alan Whitus, who was updating the Keaton and Whitus basic text on insurance law. And I think both Professor Whitus and Professor Keaton would be rolling over in their graves seeing what has happened to the industry that they were so passionate about. And I think you would agree with me that that industry has changed radically in the 25 years that I've been talking about.
Yes, in particular going from mutual companies to
Absolutely.
Publicly traded companies.
And a lot of those demutualizations resulted in a significant financial loss to policy owners who owned the shares of those who owned the mutual companies, and during the conversion, in many cases, were screwed out of their financial share of those companies.
I might not use the same verb, but I will agree.
I think you get my point.
But I think it's important for everyone to know there's a very strong tension between policyholders' interests and shareholders' interests in a publicly traded company. The board and management has a fiduciary interest to shareholders under our law, fiduciary interest to shareholders, but at the same time, whenever they release capital to satisfy that, to get a bigger return on equity, they are necessarily taking incremental protection away from policyholders. Yes.
And they also have a fiduciary obligation to policyholders under their contractual obligation with the policyholder.
Yes, sadly there's some debate actually, because they've been so trained under our law and after Enron, et cetera, to worry about fiduciary duty to shareholders, that there's a good argument that although it's in their blood to worry about policyholders, the legal requirements are a little bit gray, actually.
Well, one of the things we know, in your opening statement, you said AIG was not strictly an insurance company, and that's one of the big problems, because insurance companies are fond of talking to consumers about gaps in coverage and how they should eliminate those gaps. But based on both of your testimonies, we've got a massive $63 trillion gap in coverage, where we've got a product that, according to most common sense interpretations, would be considered insurance. We're not regulating it in the state insurance commissioner's offices. We've taken action in Congress before I got here to declare that it's not subject to gaming regulations, which again, under the Constitution, are historically made by states rather than by the federal government. And you've eliminated any oversight from the Securities and Exchange Commission, which has the only federal capability to exercise jurisdiction over these companies. So how did we get here?
I wish I could have said it so clearly. I don't know. I don't know how we got here. We thought it was important to permit leverage. We thought it was important to permit risk mitigation, and we thought that mega holding companies were accretive to shareholder value and to be competitive. And I will say that one of the big issues is, but after Basel II and what's called Solvency II, which I'm sure you've heard of, we are in danger of going the European route, which is a lot more holding company control over the operating companies, which is code for much more ability to move around policyholder money. That's what we're talking about, around for holding capital liquidity purposes. If AIG had been under a Solvency II regime, I would think we would be in much worse straits than we are today.
But one of the concerns I have is this blurring distinction between financial services providers, real estate, insurance, banking, other financial institutions, and how you hold accountability when these holding companies are involved in all these different financial services. Because clearly the system we have in place now is not working. Is it time for Congress to revisit the fundamental premise of the McCarran-Ferguson Act and talk about a federal intervention that takes into account the need to have some oversight of insurance companies that choose to engage in risky financial propositions like the ones we've been talking about today, with no ability to have accountability to their shareholders?
Earlier I said I think I would recommend a revisitation of Graham Leach Bliley and this concept of supermarkets when you're dealing with policyholder money and depository commercial bank money. I'm not sure. I'll just remain agnostic whether the solution is a federal oversight or continue with the states or some hybrid, because I think that it is important to have states in the solvency business. They've done extremely well on that. They've done not so well, clunky on other things like product registration and licensing of agents. We're pretty clunky on that. But the one thing we got right, and the reason that we're even here today, to the extent there's optimism here, is because there was solvency done by state regulators.
And just to follow up on Mr. Sauter's comment about the guarantee funds, you would agree that most state insurance laws provide a cap on those guarantee funds, typically in the amount of $500,000 or surely $1 million or less. And when you're talking about an exposure of $63 trillion, that would have no impact to protect taxpayers.
Actually, New York is one of the richest guarantee funds, and I think the numbers you just described are New York numbers. Most states are, this is not to be pejorative to other states, but most states are substantially lower. Some people think that lower is better because it stops the moral hazard of writing bad policies because there's always the guarantee fund behind it. But yes, it would have been a real stress on the system, undoubtedly.
Thank you, Mr. Braley.